Hello, Maverick Traders. Welcome out to your midweek update for March 15th. Corey here, filling in for Joe Jensen. He'll be back next week. Always an important reminder to make sure you follow your trading plan, and let's go into it. I really want to have a broad discussion about what's happening in the markets. There's just crazy chaos, turmoil, a variety of different things happening. Let's make sense of it together, and maybe even before we pull up the chart. Ultimately, I want to have this big discussion about the bank run, the bond market, and let's make sense of where we're likely to go, what the fundamentals are. So, Silicon Valley Bank and the bank run. Let's do a full review of what's happening, what it means for markets, the stress in the system, how some of what's happening is actually good for relieving some of that stress and such. So when you're a bank, you obviously bring in deposits, and there were record amounts of deposits in that 2020 time period because checks were going out, people were collecting money, and there was just this boom of inflow of capital to make sure that people could make it through COVID and so on. So they brought in all of these deposits, large amounts of deposits. Now, against those deposits, they make loans, and of course, they have ratio levels where they say, okay, well, if we bring in X amount of deposits, then we can make X amount of loans. And let's just say that they bring in $1 billion worth of deposits. Well, they might make loans against that. And let's just hypothetically say they do $5 billion worth of loans. Now, these deposits that they bring in, this capital, they could just leave it sitting there in cash. But did you know that there's something that's considered cash that's actually a security? U.S. government debt is considered zero risk in the financial markets, and that can create some problems because there can be risks associated with it. But cash and cash equivalents, U.S. government debt, is considered the same thing. They're considered equals, right? Because the U.S. government has never defaulted on their debt. They've always paid off their loans, and so the expectation is that they will always be able to do that. They can print the money if necessary and so on. So rather than having the money sitting in cash, which has 0% yield, when you leave your money in a $100 bill, it will still be a $100 bill 5 years later, 10 years later, 15 years later. Now, it doesn't have the same purchasing power, right? It loses purchasing power over time. That's what inflation is. Over time, $100 will buy fewer goods and services than it did previously. There is zero yield. It just stays. $100 is $100. If I go and put that money into U.S. government debt, now I'm collecting some yield. Now, it might not be a lot. Let's say it's 2%. But you say, okay, I can put this cash into a cash equivalent and generate some yield there, and I can go out and make these loans, and maybe I'm collecting 5% on this loan, and 6% on this loan, and 7% on this loan, and so on. And so there's multiple streams. There's multiple ways of bringing in money, right? If you're a financial institution. Now, this seems all good and everything seems fine here to this point in time. When banks do this, they understand that they're making loans more than what they have capital for. But the expectation is that they'll be fine because not everyone's going to want their money back at the same time, right? It's sort of like a gym membership. If I sell gym memberships, I can sell a lot more memberships than I have the actual equipment for because I know everyone's not coming to the gym at the same time. If for some reason everyone shows up wanting to use the same equipment at the same time, there's chaos, confusion, all sorts of cancellations, people want their money back, whatever, right? That's sort of what a bank run is everyone says they want their money back at the same time. And this creates an enormous amount of stress because in the bond market, it's true, you have zero risk in essence if you hold to maturity, assuming the U.S. government always covers their debts, which they can do because they can just print the money for it. But let's think about how the bond market works. The bond market works by selling a bond at its value, and at maturity, it will be worth, the same amount of money down the road at maturity. So in the bond market, you are putting money into a bond. You're basically lending someone the money. If it's the US, you're giving the money to the US government, and they're providing you with some interest. And at maturity, they're guaranteeing that they'll pay it back to you. Some bonds could default and you not get your $1,000 back, but US considered zero risk to that, right? So at maturity, we know it's money good. We put $1,000 into the bond. The US government pays us back $1,000 at maturity. And let's say that maturity is 5 years away or something along those lines. Here becomes the problem. Your bond for $1,000 is still worth $1,000 at maturity, but it's not worth that early on. What could cause the bond price to go down in the short term? Well, let's say a year later, yields have gone up dramatically, and that's what's happened, right? This bond might be paying you 2% per year, but if yields go up dramatically and now the same style of bond is yielding 5%, what does my bond look like by comparison? Does anyone want to buy my bond from me for $1,000 and get paid 2% per year when they could basically buy the same bond getting 5% for $1,000? No, they won't pay me $1,000 if I want to sell it in the secondary market, right? You can buy a bond at its issuance. You can buy and sell them in the secondary markets. But here's what always happens. If yields have gone up, the bond price has gone down. My bond is not worth $1,000 if I sell it early because it's basically discounted because it's not as good as the existing bonds in the market. My bond value has dropped. Now, if I can hold it for 4 or 5 more years, I'll get $1,000 back, but I'll only be collecting 2%, whereas everyone else is getting 5% over that next few years, right? And so if I want to get out early, I can sell it and someone will buy it, but basically they're going to do the math of 3% less per year times this, this quantity of years. Well, that bond, I'll buy it, but you got to sell it to me at a discount because here's what bonds are worth now. $1,000 bond is worth 5% per year. If yours only yields 2, you got to sell it at a discount. That's just the math of it, and it will always work that way. So if people come running back for their money, what does Silicon Valley Bank have to do? They have to sell assets to come up with the money to return to all these people that are showing up at the door saying, we want our money back. We want our money back. And the more people show up, the more assets they have to sell. And if their bonds have dropped a ton in value, now they're locking in huge losses. And since they were leveraged, they might only have a certain amount of leeway. If they lose 10, 20% of their equity, they might be wiped out in essence because they made loans leveraged up compared to how much money they actually had. And now they're returning all this money to the people that are showing up at the doors, locking in losses, which is wiping out their equity. And so you can see the problems with this. You can see how these banks are saying, we're selling these at a huge discount. It's worth more than that. But this is the problem. There was a news story that before SVB went under, and I don't remember the exacts, but the story came out just today, I believe, that Goldman Sachs was buying. So Goldman Sachs trades under symbol GS. SVB, I don't remember their SVBI maybe is the symbol. I don't remember what it is. But anyway, Goldman Sachs was buying an enormous amount of their bonds at a discount. So they were buying something like $30 billion worth of the bonds for $24 billion or $22 billion or something. this company was losing a ton of money, and it's this dynamic. They were selling assets that were worth a lot more than that at maturity, but selling them at huge discounts, and maybe even because of the stress of the markets and so on, maybe even taking a little bit bigger hit than that. So anyway, make a long story short, if everyone shows up at the same time wanting their money back, the bank is in a world of hurt. Now, because of this stress in the markets, people go towards risk off. And if they go towards risk off, what are the assets that perform best in that environment? Well, usually the US dollar will catch a bid because it's considered the safe haven currency of the world. It's the largest economy, it's got the largest military, and so on. If you're looking at currencies, also the Japanese yen. Japanese yen tends to go up for all the wrong reasons. It's because it's the most heavily shorted. So when people get risk off, they actually have to cover their shorts, which fuels the yen going higher. But these are defensive currencies. The Swiss franc tends to go up because, again, for the longest time, the Swiss wouldn't share information on their banking and so on. It was considered kind of a safe haven. These treasury bonds, anything U.S. government related, they come after them because, again, people want to buy where they know they're going to get their money back and get some yield. This is basically going to cash, but instead of going to cash, you go to something that's paying you 4%, 5%, 3%, right? But you're essentially going to cash. So here's the weird thing about this. Because there's chaos due to yields going up so rapidly, people rushed into U.S. government bonds, which drove the prices back up, and the yields have been coming down, actually creating a better circumstance for any banks that are in a similar situation to this one. Because people are rushing into U.S. government debt in a panic, yields have been falling, and the two-year bond, the two-year treasury went from 5% to 4% in a flash. Dropping 1% in about one day is unheard of. It tells you how much enormous amounts of money rushed into that bond market. It literally takes billions and billions and billions of dollars to move, maybe it's trillions, but it takes an enormous amount of money to move that yield from 5% down to 4%, or in other words, to buy that many bonds and that rush for safety. So there is stress in the markets, but oddly, what was creating the problem is actually being offset somewhat by investors rushing for safety. It kind of helps to create less of a problem. And that's good news. That's kind of good news. Then you could say a few other things, right? You could say, well, that's good for markets, that what was causing the problem is some of that stress is coming out, right? If a bank has to sell their assets, they're losing less now, just a week later than they were last week, a lot less. Billions of dollars less now than they were last week. You could also say that the Fed is less likely to raise rates as aggressively. It was almost a foregone conclusion that the Fed was going to raise rates by 50 basis points next week. It now is far more likely that they'll only raise by 25, and it's a possibility that they might not even raise at all. And that the terminal, kind of where they stop, is going to be lower than where it was before. Fewer Fed rate hikes, less of a spike that way. Yields coming down. We know when interest rates come down, that's good also for consumers, for businesses. We want lower rates that spurs on economic activity. So interest rates, that's a positive. Less Fed aggressiveness, that's more dovish. That's a positive. What was created some of the stress is coming out of the markets a little bit. That's a positive. A few other things here. Oil prices are absolutely getting demolished. They're down 11% this week. That's a positive for the economy as a whole. When you think about inflation and asset prices, they're coming down pretty dramatically. Now, CPI on Tuesday was not perfect. it came in at expectations, 0.4 for the month, 6% annual. But PPI, which came out this morning, was much better, much lower than expected, which is, again, a positive, a sign that inflation is still backing off. We would love to see that in the CPI, and had you seen that in the CPI, wow, the markets would have really jumped. But there's delays and so on. Now, it's not all positive. These are all positives in my mind. Let's talk about some of the negatives. Well, the biggest negatives is how much stress is there in the banking system. The banks, when they start to get like this, where there's collapses, banks start to not trust each other. Liquidity dries up, basically fewer loans, banks play it safe. These are drivers for economic activity. The probability of us hitting a recession and having this hurt the economy in some way has certainly gone up. And I think that's why oil's getting hammered so hard. These things, it's not all roses. Let me make that very clear. I think there's still some real stress in the banking system. The odds of recession have certainly gone up on this, not down. So there are some issues to still deal with, but hopefully this kind of review of the whole what's happening and what created this, and hopefully you followed as we kind of went along, clears up some understanding and some, some ideas of what's happening here in the broader markets. So as we come over and look at a few things, we'll look at a few trade ideas, we'll look at a few charts, we'll look at a few things. But here's that chart of just short-term treasuries, and it's good and bad. This is bond markets skyrocketing. So yields are doing what? They're plummeting. They're moving opposite to this. If we were to spread out the duration, this is 1 to 3 year, here's 7 to 10 year, same thing. Bond market spiking, yields dropping. Here's the longer term bonds, same thing. Big spike up in the bond price, yields are coming down aggressively. That's very good news. That relieves a lot of that pain and stress that was created by the opposite moves, right? So some of that is a positive for markets. However, this rush for safety, if you were to back this chart out a long ways and you say, well, when have we seen this type of dynamic, that much upside in such a short period of time? There's only a couple of times that you can really kind of reference. And one of those happens to be when? 2020. So this is a weird dynamic where we needed it to happen to relieve some of that pain, but also its very nature of it happening speaks to a lot of nervousness, fear, rush for risk off, and so forth, right? This sort of correlates with the VIX. If we were to look at the volatility index, it's somewhat similar in that where do you get the biggest spikes in the VIX? Well, if we were to look at some of the largest spikes in the VIX, they're usually when there's chaos and confusion. Interestingly enough, the market's not saying that this is anywhere close to 2020 from that standpoint, right? The VIX exploded from literally 15 and then over, this is a weekly chart, but over the next 4 weeks went all the way up to 70s and 80s because the entire economy shut down. This is my point. We're not in a 2020, but there is real stress. There is real fear. We've been in a bear market. So where does this put us? Where do we go from here? Well, it's probably a situation where you've got to look at your spots and kind of pick your spots and say, okay, well, where do I think we're going? What do I think this is an opportunity to do? Naturally, I'm inclined to take profits on the flushes to the downside. I referenced this yesterday in the market roundup that if you're bearish, why are you bearish and what are you looking for? If you're bullish, why are you bearish and what are you looking for? And I reference them, I call them exhaustions. In the markets, they'll often be referred to as capitulations. But a good way to think about it is, are you at more of a breakout level or more of an exhaustion point? And so you have to use context around that. If it were to happen following an extended price move that's way off of the moving averages and so on, then it would be more of an exhaustion. If it were just starting a reversal or a breakout, then it would be more of something that's sustainable. What do I mean by that? Well, if we look, here's a massive bullish candle. To me, that's the very start of the upside race. That was the huge reversal that kind of started it all, right? Something similar to that might be back here, where this was sort of the start of the major downturn. See how dramatic this drop was, and then how we kept falling from there. Well, if this is the start of the race, then you kind of go up to the moving averages and battle it out, and then you kind of break out above them. Everything seems okay until here, in my mind. And that is a problem because now we've already stretched a long way. We're extended away from shorter term moving averages. The breakout already occurred back here, kind of up and through the moving averages, and to basically end this equilibrium of sorts, right? Which way do we go? Do we break back down? Do we break out? Well, that's a breakout, right? This started the race. This is kind of that grinding. And then this was the punch to the finish line. When you think about exhaustions, usually you'll have massive volume. Both of those, the exhaustion point was a huge volume spike. Well, you can't see the volume, it's kind of hidden, but here was a huge volume spike on this reversal. So this one, I mean, it could be, but it was more of just breaking out of this indecision around the moving averages. My point is that there's usually kind of a starting point, and then when you get up in the air or down way stretched away from moving averages, that's more of the exhaustion, and we're just temporarily done with the race. And you'll usually see a spike in volume and such, right? So here we've been moving lower. We had a little equilibrium point. We broke down from there, and now we keep falling, 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 and we see this big influx of volume here on this exhaustion push to the downside. I'm usually just more inclined to be a profit taker into that type of move, feeling like the downside started back here somewhere. This would be more of the finish line, right? It takes you to the moving averages, then you break away from the moving averages. Now you get a little mini exhaustion. I suspect, now, again, the reason I'm a little bit, like I took profits on bearish trades the last 3 days. I took off even more today than I had yesterday on the bearish side and so forth. And right now, it looks like we're extending to the downside. We'll see, but I kind of feel like this is a little bit of an area where you probably bounce. And to me, anything that has kind of hit price targets and has most of its profit and so on, I'm more inclined to take it off into the flush to the downside because that's why I was bearish in the first place. And then maybe if we get a bounce up and you get a nice bear rally short setup, then you re-up and you start to resume that downward trend. I would say this with some caution though. Is there more potential for this market to just keep cascading lower than there has been, in most of these environments? Yes, absolutely. The VIX kind of shows that. The flight to safety trades show that there's real stress and real panic. So the possibility for us just kind of cascading lower is there. It definitely has that possibility. I'm not discounting that as a reality of what can happen in this market environment. I would love if we get a bounce because I have taken off a good amount of bearish trades. I was highly bearish. I think I had, for most of this downward run, I was about 80% bearish, and I even had some neutral trades. So I really was bearish coming into all of this. Now I've taken off a good portion of that. I still have a slightly skewed bearish but not much. I've taken down a lot of my exposure, and now I just have fewer trades both sides, because I haven't been adding a lot of bulls, but I've been taking off a lot of the bears and just kind of scaling down a little bit in the shorter term. So that's how I see it. If we get a bounce and we get a short-term kind of correction and whatnot, I think that should occur here in the coming days. Then I'll probably reinitiate shorts pretty aggressively up into that rally and up into that lower swing high. If you were going to buy something, the tech space does look better. If you just look at QQQ, I mean, even today, it's just holding up better. I mean, it's still above its 50 MA. It's in a channel here. It's a little bit stronger setup, this bull flag and such. I don't know if it'll break out to the upside, but it's definitely not giving ground like a lot of these other markets. And what's really getting hammered right now is just the energy space. USO, this tracks oil to a certain extent. It's not perfect at it, but you can see the oil market's just getting absolutely hammered, down 7% today alone. They've been in a descending triangle, and this creates the energy sector just tumbling over. So kind of a problem more for that sector than it is for the broader markets. Like, you look at the NASDAQ and it doesn't look like there's that much going on here, and we still look okay. You look at the financial sector or the energy sector and it tells an entirely different story. So it's not a broad market collapse, but right now the financials and the energy sector are the two that just have a ton of momentum and a lot of downside pressure. Does this look similar to mid-September's price action? So let's go back to mid-September and let's take a look here at what you'd be referencing. So here's kind of that mid-September period, and I mean, possibly, certainly possibly, like for me, I probably would have, and I don't remember exactly what I did, but would I have taken profits on bearish trades down in here? I think I would have. And this is a good example of where you can actually have some regret, but understand that most of the time that's not going to happen, right? But it is the possibility that, to your point, could it be similar where this just keeps cascading? Yes. And we're in that type of market where that's a possibility more than it is in most circumstances, right? So could you have kind of an exhaustion flush and then there's just not much bounce, right? No signal works every single time. There's no such thing as like a perfect setup that, oh, it's 100%. We're always playing probabilities and we're weighing the evidence and we're saying, okay, what have I had experiences like this before and how do I think this plays out? And I don't think it's that personally. If it wasn't for the fact, let's say that the bond market wasn't reacting the way it was and yields were still way up. Now they're still high, but going from fives down to fours and threes has relieved a lot of the stress. Let's say that that hadn't occurred, that the problem wasn't getting solved, then I would say the probability of that cascade would certainly be higher. But remember, the discussion that we've just had is what got us into this mess is actually getting fixed to a certain extent. That reduces the probability of that in my mind. And I hope that makes sense. So could it happen? Yes. Is it likely to occur here? I don't think so. I think we're probably going to have a little bit of a relief bounce, and this has been a market up to this point where you've been certainly rewarded by not chasing a lot of momentum, instead waiting for the right pitches to swing at. Like, I thought that we would get a bounce and we would have, a lower swing high and so on, and it didn't happen perfectly where I thought, because we chopped around a bit and then we finally got that big spike. So it gave you that setup, but it wasn't precise. I generally say I'm really good at figuring out what's going to happen. I'm not so great at figuring out the precision of when. Like, can I predict to the day that this will do this and it'll follow this and it'll go up for the next 3 hours and then down? I just can't predict all of that. But I can figure this out quite often. And this leads me to believe that we'll get a bounce. But I don't know. I even mentioned yesterday, I thought we would back and fill this area. So I thought you'd get basically a filling of this gap and such. And we've done that. This still fits my expectations of what's transpiring. And if you're taking profits in S&P 38.54 and then reinitiating your shorts up here into 39.50, 39.70 and so on, that's good trading if it bounces. If it doesn't, well, you're going to wish you had left some of those bearish trades on. So you got to look at each trade and look at your plan for those trades and so on and make your own decisions that way as well. Does your thesis change if we break the 3-month low of 37.50? Great stuff. Thank you. So if we break the 3-month low over here, I tend to give breakouts less credence than most people. I don't play a lot of breakouts, especially when, and this is my own philosophy, when you're not at new highs or new lows on a bigger scale. The problem for me would be, even if we break this low, you still have all this underlying support. The probability that it just, continues to pick up momentum and so on, you still have prospective buyers that want, imagine you basically shorted the market back here, you want to be a buyer. Imagine you sold your stock for some reason back here, you want to be a prospective buyer. That this is the problem when you have overhead resistance. See how it tried to break out, but you had overhead resistance and it just can't run higher. It's just messy because you got all this recent price action that keeps a lid or it keeps a floor under things. The best breakouts are those that have no overhead resistance. So I often do this quiz where I say, okay, this breakout versus this breakout. They're both breakouts, right? Which one's better? Well, this one every time. This one's a new high. It has no overhead resistance, no disgruntled former buyers, no dead bodies over here. This is Michael Jordan and he can fly. This is Michael Jordan and he's got all this weight on his shoulders. As it tries to break out, it's got all these sellers, this old supply that's still hanging. That's what resistance is, right? It's all those former people that bought poorly and so on. And they want their money back and they're sellers and there's millions of them back here. And so it just creates more of a problem. So the markets would have the same issue here. We're in more of a huge range, and so these breakouts can't really be trusted. And I'd say the same thing about a breakdown there. That's my personal approach, which serves me well. I just wouldn't trust playing the breakdown or anything like that. I'm okay with the bearish side of trading, but I'm going to do my shorting into the bounces. If you didn't feel like you were bearish enough and so on, you use even just yesterday's bounce. That's a short opportunity if you want to add more bears and you think we're going lower, more so than kind of chasing on the way down. That would be my thoughts. I'm seeing the chart as bearish, also thinking we unwind a lot of the hedges Friday, ex-dividend for S&P. Hedges seem to make things less sticky above 390. Anything to watch for in the charts, and candles on Friday with all of this going on. So options expiration always brings more potential for volatility because you have delta hedging that goes on. Delta hedging is something that's basically fuel to the fire, right? It stokes even more. And if the market starts to get away from certain levels, the market participants, basically it's a domino effect. This domino triggers this domino, which triggers this domino. And you do have some of that risk into Friday that as the market's selling off, people have bullish option trades and things that they have to hedge. And the way to do that is to short more stock, right? So say I had some bull put credit spread, or say I had some iron condor or something. Most of those are getting hit to the downside. And so it fuels more selling because they have to short stock to hedge to make some money on the short to offset the loss in the option. And that triggers more selling because now you got liquidations and margin calls at different brokerages and so on. I think that dynamic is indeed playing out in energy and financials. Those are the two groups that are seeing, from a statistical standpoint, breaks that are harder and more severe than what the market was pricing in, and therefore they have a lot of delta hedging and a lot of aggressive shorting that's happening in those markets to head off some of the risk that they have. I hope that makes sense. So in financials and energy, absolutely. It kind of speaks to when you think about the RSI indicator. An RSI indicator is generally perceived as like a bullish or bearish, overbought, oversold, but that's not really the right way to use it. Let me explain what I mean by that. If I come over here, let's pull up RSI, and I'm going to throw it above the chart. And when you get oversold, quote unquote, oversold, this is a misleading statement for most people because they think, oh, it must be a good buying opportunity. Actually, I teach it the exact opposite. When you first go oversold, it's like you're going into overdrive. It's like things speed up because this is where massive amount of hedging and those sorts of things, where you're breaking the statistical barrier. So if I were trading at RSI, when you first break below 30, that's a short setup for short-term traders. Now, it doesn't last for weeks on end, and it'll probably recover at some point. But the point being, when you first go oversold, you want to short. You don't want to buy. Now, eventually, you want to take profits and so on. But look at XLF. When it hit oversold, things rapidly increased to the downside, right? They sped up the selling pressure. This is where hedging and some of those things occur. Look at energy. If we were to use that as an example, you can do it on individual stocks. We're just going into oversold within the last day or so, and certainly you wanted to be more shorting that market, not buying. And you can see the selling is speeding up. It's intensifying, right? Same thing happens on the upside. When something breaks higher and gets overbought, well, let's use this same one as an example. You don't want to be shorting it. You want to be, again, it goes into overdrive. It speeds things up. So here we first got overbought. Okay, look at how it sped up to the upside. Or back here we got overbought. Went a little higher. That was only for 2 days. Here you got overbought, and I would say that one was kind of not great, but here you got overbought, and see how it sped up to the upside thereafter. Or same thing here, or same thing back here. In all of those instances, except for really kind of this one, which, by the way, there's another lesson in that, but in each of those instances, we sped up and we went sharply higher. There is something called a divergence, which is a warning sign that if you look at, for example, here, when you start getting overbought multiple times, but one overbought is lower than the other, but the price action goes higher, that's called a bearish divergence, where basically you're running out of momentum. And I don't use a lot of indicators. There's only 2 indicators. I can tell you all sorts of things about the MACD and the stochastic and the this and the that. I use 2 indicators only. I'll use RSIs and I'll use Bollinger Bands. That's it. Those are the only 2 things I use because a lot of my stuff is based on statistical analysis and so forth. But That's it for me. I use RSIs and Bollinger Bands, and this is how I use it. And I would expect things to speed up, not slow down. But then if you start seeing divergences, that usually is more indicative of a top. And that happened to be the top. Um, right now, we have no divergence. Energy probably continues to go lower. You'll get some bounces and things. But for the next couple of days into options expiration this week, it's probably going to intensify to the downside in energy. Looks like there's more downside to come. Yeah, I mean, shorter term trades, you can do a lot of different things. For me, I've scaled down a bit because I was short. Now, this is one of those unknown unknowns. There's a difference between a known unknown and an unknown unknown. Known unknowns happen all the time. A Fed meeting, it's scheduled. We just don't know exactly what they're going to do or say. Earnings, there's a date, there's a time. We just don't know what the earnings are going to come out to. These things get priced in a lot of times because they're already, the market's able to say, we can figure it out ahead of time for the most part. There might be this that's a little different than the markets were expecting, little pricing differentials, but usually not a major shock and a surprise. This was an unknown unknown. This banking crisis, this that's happened over the past week, this is not priced in. It can't be priced in. Why? Because it came out of nowhere. It was not scheduled. It was not planned for. It was not expected. And now we've got all the unknown ramifications of that. So I was short the market, but when an unknown unknown hits, you know that it can be a little bit more violent. There can be a more extended move. There can be more volatility, not less, because it's not mostly priced in or even all the way priced in and so on. So it was an unknown unknown. I'm not going to be surprised if we get more extension to the downside because of that. But for me, I've been taking profits and just scaling down. I'm getting less risk in my trading altogether because I have fewer trades. I'm still going to try to pick my spots and do my things, but for right now, I'm just kind of waiting for the next great pitch to swing at. So I think there will be a bounce. That's what I'm hoping for, and I think it'll probably be a great short setup, but we'll see. We did have a request for CrowdStrike. So CrowdStrike, call spread, idea. CrowdStrike is better than most, no doubt about that. It does run into the problems that I talked about before, which is hard to play upside when you have a lot of overhead resistance because you'll just get a lot of checkbacks. You'll get a lot of failed upside move and then they'll check back. So if you're buying the dips, great. If you try to play on the upward momentum, it doesn't work quite as great, you know. So I would be, we're kind of already bounced for 3 days or so. I would call myself more neutral on this type of chart than anything else. You've got overhead resistance, you've got a 200-day up here, you've got the shorter term moving averages down here. That to me is just more of a neutral. You're right in this gappy area, it's kind of stuck in that range, more of a neutral. You did see the exhaustion high right there. See how it gapped up on earnings, and that's marked the peak. So that's sort of a little bit more bearish signal where you could argue that the race began back here and this was the sprint for the finish line, and now we might have a little bit deeper correction for a while before we resume again. So because we just hit an exhaustion, I'd probably even call myself neutral to maybe thinking there's going to be more back and fill. Often after an exhaustion, you get a full correction. And a correction is more than just a pullback. It's a deeper decline, right? It's a couple of waves down. It's an ABC type of thing versus just a normal little pullback. So when you get an exhaustion, often you'll get a correction. that even makes me a little bit more cautious that way. So I hope that's helpful. Of course, I always give my opinion, the way I see things, the way I think things will play out, but ultimately, I don't have a crystal ball. I do get some things wrong. There's just no doubt about that. So make your own decisions based on your trading plan, and if it's a good system you've got in place, stick to that because it's working. See the divergences there in the RSI. So, yeah, I don't use MACD. MACD, you could use it for divergences the same, similar to the RSI, and that would be the only way that I would use it personally. I prefer the RSI even to the MACD at this point in my life, but I could tell you a lot about a variety of those different indicators like MACD, moving average convergence, divergence. The common settings are 12, 26, 9, developed by Gerald Appel, nominated for a Nobel Prize. I could tell you, you can speed it up with an 8, 17, 9. I've used it in the past. It's just not something that I find all that helpful, so I haven't used it for many, many years. It's funny, and I tell this story when I first started trading. I mean, I had indicators galore. I had 12 up here and 20 down here, and it was just, I thought that was going to be a life changer. And I used an old program that's called Realtic, and it was evolutionary. This is back in the early days of the internet, basically. And I mean, we thought it was amazing, and you only paid to buy and sell stock. It only cost, like $12 or something per trade. We thought that was amazing. And then Scott Trade later came out with $7 per trade. And we were like, are you kidding me? That's ridiculously cheap. And now you can trade stock for free, so worlds change. But for the last 20 years, I just don't use indicators all that much. I use Bollinger Bands, RSI, price action, and I find that to be much, much more helpful. Yeah, so GOLD, the gold area has a bearish Bollinger Band setup. So if you look, I already saw this earlier today to Scott's question and point, hitting the upper band below the 50-period moving average. This is a stock GOLD, which is Barrick Gold, but if you look at GDX, which is the gold mining ETF, same dynamic. See how it's hitting the upper band below the 50 MA? So I saw that earlier today and actually made an adjustment on something that I have in the gold space because of that, for a little bit more bearish possibility. And my thought is that, again, I trade the setups in front of me that have good risk to reward. This one doesn't fit my overall outlook. I kind of look at this as, gold and silver should do okay in this environment, but they've already done that, and now it might be mostly priced in. It wouldn't shock me if these have a period of deterioration, that they've gone through their correction up, and they're going to have another little wave of selling. That's what the charts suggest according to that setup. So gold miners on the more bearish side right here, right now. That's the way it looks. All right, hope you enjoyed the market midweek today. Have a great rest of your week. If there's anything we can do to help, don't ever hesitate to ask, and we will see you all next time. Goodbye, everyone.